5-Minute Financial. It's me, Hugh Riley, and John Klotz is here, our financial guru, and we're having fun. We're just about to hit the clock, and once we do, if you stick through to the 5 minutes, you have a chance to win a $100 gift certificate. Right, John? So, you ready to hit the clock?
Ready to go.
Okay, I'm hitting it right now. We are go. Okay, today's topic is corporate life insurance. John, I don't even know what that is.
Well, you know, Hugh, you are a business owner and a successful one at that. And corporations buy life insurance just like people do.
Okay, but is it for the corporation or is it for employees? Or I'm confused.
Well, this is the amazing things because, as you know, we work with people who are self-employed. And a lot of people are self-employed, but they have their own personal corporation. You can actually take out a life insurance policy on your life that protects you and pays your beneficiaries in the event something happens to you, and pay for it with corporate dollars versus personal dollars.
Okay, that sounds like it sounds like you really need a financial planner to figure this out.
Well, here's the thing. In Canada,
Yeah.
the tax system is set up for corporations. The personal tax rate for anyone earning over, say, $108,000 a year is about 47%. So that means for every dollar you earn over that amount, you're paying 47% tax. Corporations pay 15.5% tax.
I even heard them on the debate
Yes.
say that Canada had a lower corporate tax rate.
We do. You watched that debate too,
I
huh?
did.
We're dating ourselves.
Okay.
There you go.
All right.
But absolutely. So if you are, so for instance, Hugh, you own a corporation, correct? Okay.
That's right.
But you're also a human being with responsibilities.
Some people say that.
What? The responsibility part or the human being part?
Both.
Both. Okay. All right. So here's the thing. Let's say you had a family at home, a young family, and you needed to have $1 million of life insurance on yourself.
Okay.
Right?
Yeah.
Just 'cause.
Yeah.
And you're making, you know, I've looked at your tax returns and I know the millions of dollars you're making through your endeavors. And you say, okay, I am in this very high marginal tax rate. I need to buy $1 million worth of life insurance. I can either pay for it myself personally in my 47% tax bracket.
Right.
So I have to pay more for the policy
Yeah.
because I have to pay 47 cents on every dollar that I pay for this policy. I'm in a high tax bracket.
Yeah.
Or I can have my own personal corporation own the policy and pay income tax at 15% versus 47. Where do you want to be? Right?
Yeah.
You want to be over here at 15%.
On the corporate side.
Now, here's the thing. On an individual side, if you own this personal life insurance and you die, it will go immediately to your beneficiaries tax-free.
Right.
Corporation's a little different.
Okay.
But it can actually go to them tax-free too, and here's how it works. So let's make up a corporation, Hugh Riley Incorporation, period.
Okay.
Right?
Yeah.
And Hugh Riley has a star employee named
Blue Orchid.
wrong. Hugh Riley.
Oh, okay.
Okay. So Hugh Riley, that is true though. She is a star employee.
Okay.
And we want to treat her very well. That's the next 5 minutes.
All right.
So what we do is we take out a policy on Hugh Riley, but we have the corporation own it. So it's the same premium as it would be on the outside world, but the corporation owns it, and the corporation pays for it at 15.5% tax.
Yeah.
Now, Hugh goes along. Hugh drops dead at the age of 60.
Yeah.
Let's say it's a policy for $1 million. The $1 million gets paid to the corporation.
Okay.
It then goes into something called a capital dividend account. And
Which
what
is
happens
my next
is,
question.
go ahead.
Yeah. What's a capital dividend account? How does that work?
Well, okay. So great question. So what happens is this $1 million flows into the corporation.
Yeah.
And then the adjusted cost base of the capital dividend account increases by $1 million. So you now have your spouse, Mrs. Riley, who now owns the shares because you left them to her, saying, I am going to do a tax-free tax-free distribution of this money. She takes out $1 million tax-free through the capital dividend account.
So you're winning on both sides.
Winning on both sides.
You're winning paying in, and you're winning if you have to cash out.
Exactly. So now here's the other thing too, by the way.
Don't have a lot of time, John.
How much time do we have left?
27 seconds.
27 seconds. You can actually build up a whack load of cash in this policy within the corporation. and you can use it to fund your retirement. How's that?
I don't understand.
Well, here's the thing. Life insurance is a tax shelter.
Okay.
And you can actually overfund these policies. So you can pay the base premium, but then you can put more money into it in the corporation, and it accumulates tax-free. And you can actually...
Uh-oh. I want to hear that.
Actually...
But we don't have time.
I know.
So there's only one way for people to get the info. They have to get in touch. And there's a way for them to do that
Absolutely.
and get a $100 gift certificate. How do they do that? They go to the website.
Go to 5minutefinancial.ca, fill out our questionnaire, and on top of that, you'll get a $100 gift certificate through Discount Dining Dollars.
Fabulous. Corporate life insurance. Who'd have thunk it? Thanks for tuning in, everybody, and we'll see you next time.